Adobe's stock price has dropped by about 50% over the past year and a half. So today, as a value investor, I want to take a look at whether this might be a really good entry opportunity. That's why I just want to take a look at the risk-reward ratio in this video. We're here in the X Station 5 from XTP. Since February 2024 until today, the stock price has dropped by 48%, from $634 to now only $330. And we've already seen a similarly sharp drop here back in November 2021. Back then, the price was even higher at $700. And it dropped further to around $273, a loss of just over 60%. After that, things shot up steeply again over the next few months, up 130%. And now, as I said, we're back down significantly, putting us at a similar level as in January 2020 or even December 2019, so right before COVID. So basically, nothing has happened here for 5 years. And that's even though the core business has continued to grow, which means the valuation is actually even more attractive now, and that could be a good entry point. The current market capitalization is $140 billion, and we see a PE ratio just above 20 for a globally recognized company with very strong financials, as we'll see in a moment, and continued growth prospects. Not so expensive at first glance, and even if we look at the valuation in a long-term comparison, we can see here at the very top the stock price over the years. Since 2011, it's been steadily climbing. Here you can see these highs at just under $700, where I think we were, then the crash, then back up, and now the most recent drop. And here in the second chart, we see the development of earnings per share, which did hit a bit of a low in 2014, but then kept rising and is now at $16. And at the very bottom, we see the development of the PE ratio. In 2014, we still had a PE ratio at a high of 150, then for many years, from 2016 up to actually 2024, a PE ratio between 35 and, in 2021, even almost 70 times. And now recently, due to the crash in the stock price, it kept dropping further and further. The PE ratio, as mentioned, is now at 21, and thus as low as it was last in 2013. So that was over 10 years ago that we last saw such a low valuation level. And here we can also see just how irrational the stock market can sometimes be. Back at its peak, around $700, Adobe had an earnings per share of about $12 in 2021. The PE ratio was 55. Today, earnings per share are about 50% higher at $16 per share, but the stock price is 50% lower at just over $330. And that's exactly what happens when there are different market moods, when a lot of people are hyping up a stock, when the media reports on it positively, when many retail investors write or talk about it in a positive light and more people jump in, including big investors, of course, then that drives the price up. And when everyone gets scared because something has changed, a lot of people pull out of the stock, everyone talks badly about it, and the prices go down. Even if, as we've seen, profits are actually higher now than they were a few years ago. And the rest of the long-term development also looks very, very good. For example, we can see here that revenue has risen from $4.4 billion in 2012 to $23 billion today. Back then, net profit was $800 million, and now it's at $7 billion. And profits have also been used to buy back shares. For example, at its peak, the number of outstanding shares was 501 million in 2013. Since then, quite a few have been bought back, and currently there are only 432 million left, or as the latest quarterly report shows, even fewer. Especially in the last few years, since 2022, quite a few shares have been bought back. And right now we can see even more than in previous years. And that's actually a good sign from management. When the stock price drops significantly, they increase share buybacks, which shows they believe the stock is undervalued. There is no dividend here, as we can see. So everything here is being invested in growth and share buybacks. And as I've noticed, many of my viewers aren't subscribers yet. If you want to support my channel and, of course, always be notified when I post a new analysis, make sure to subscribe, turn on the bell, and then you won't miss any more videos. And Adobe is, of course, very well known for its products. Photoshop is just one of them, used worldwide and considered one of the best image editing software out there. And with programs like these, Adobe makes really good money and achieves strong margins because you have a piece of software that you develop once, keep updating, but can sell as many times as you want and collect a licensing fee from each user every year. And that leads to high margins of 30 to 40%, even net. So this really is a fantastic business model. But now, with all the AI hype and all the new AI software coming onto the market, software that can also generate videos, create images, and edit pictures, Adobe is now facing potential competitors, of course. Many people are therefore afraid that Adobe will lose market share here, and as a result, revenues and profits might not grow as quickly, or could even decline. This is causing many investors to exit the stock, which has led to a significantly lower valuation level now. Of course, Adobe is responding. They are now also trying to focus more and more on AI. Let's take a look at some of their products. On the left, we see already existing products, for example, as mentioned, Photoshop, Lightroom, Premiere Pro for video editing, After Effects, and several others that most of you are probably familiar with. Many of their products are known worldwide. And even there, they're now starting to use AI to improve everything. And they say that they're already generating over $3.5 billion in revenue by using AI here. In addition, there are also new products, for example, the Firefly app or Gen Studio for performance marketing, where they developed brand new AI software. And of course, these are still relatively small, but they're growing rapidly. In Q1 alone, over $125 million in revenue. Then in Q4, they're expecting over $250 million. It's all still very, very small compared to Adobe's overall revenue. But of course, they've jumped on the AI bandwagon and are trying to maintain their market position this way as well. The positive thing here, of course, is that because Adobe was already so profitable, they have the necessary cash to invest in research and development for these new AI products. And that's something that some of their smaller competitors especially don't have. But there are also big competitors who are now entering the market for video and image editing with AI, which still poses a risk for Adobe. And there have been some recent news stories about this. Let's quickly go back to April 24th. This is about the Firefly app, which is a brand new AI app. And for example, Reuters writes, Adobe said on Thursday that it is adding image generation AI models from OpenAI and Alphabet's Google. So they're also using the major AI models from OpenAI and Google for the Firefly app. And it goes on to say about the Firefly app. Since 2023, the San Jose, California-based company has been developing its own AI models for generating images and video clips in its Firefly service, and promises its customers that they will not be held legally liable for using images and videos created by these models. Of course, that's a really important point, that when you generate images or videos online with AI models, you also have legal certainty about the whole thing. And that's exactly what Adobe promises with their Firefly app. Then we move on to June 13th, and Reuters writes, shares fell 7% in early trading on Friday, as investor concerns that the integration of AI into the company's software tools might take longer to generate profits overshadowed an increased annual revenue forecast. So, even though the annual revenue forecast has been raised, which is actually something positive, there's a lot of fear in the market that all these new AI products won't be able to generate profits as quickly as initially hoped. And then there's another piece of news from Barron's in August, where Adobe was also downgraded. AI Eats Software. The Adobe stock was downgraded by an analyst from Melios Research, who is concerned about what the competition in artificial intelligence means for the creative software company. As I mentioned earlier, the competition in the AI market is currently very, very intense. But I also want to point out that Adobe's products, like Photoshop or of course After Effects and Premiere Pro, are used by a lot of professionals, and they won't just switch to other software overnight. Above all, Adobe's software has been highly developed over many years and is also optimized for a wide range of professional applications and needs. And that's why, of course, not everyone is immediately leaving Adobe. And you can also see this in the analyst estimates, because they are still expecting growth rates. Earnings per share are expected to be $17 this year, then $19.31, and $21.77. So analysts are still expecting 10% growth rates here. And yet many are currently downgrading Adobe's valuation, which means you can now get a global corporation in a very profitable industry at a price-to-earnings ratio of 20, with expected growth rates of 10%. But to be able to evaluate the company even better, of course, we also need to take a look at the financial report. Let's take a look at Q3, which ended for Adobe at the end of August. Here we have the balance sheet from August 29, 2025. So it's just about 2 months old. We see they have $5 billion in cash, plus another $1 billion in short-term investments, bringing us to $6 billion, which is almost exactly equal to their long-term financial debt. So they have a net cash position of 0, because there are no additional short-term financial liabilities. They also don't have any further long-term investments here, but they do have total short-term assets of $9.4 billion. Of course, this includes both cash and short-term investments, and these are roughly at the same level as the short-term liabilities. That's always a good sign when they're equal, or of course, when the short-term assets are higher, so that you remain liquid over the next 12 months. So, from my perspective, the financial situation looks very good here for now. Now let's take a look at the income statement. We can see that revenues in the first 9 months are at $17.6 billion, which is significantly higher than last year. Back then, it was $15.9 billion. Gross profit increased from $14.1 billion to $15.7 billion, and net profit down here also rose from $3.8 billion to $5.2 billion. So, what we have here is a growing business. Earnings per share went up here from $8.63 to $12.28, and the number of outstanding shares decreased from 452 million to 430 million. Or, if we take a closer look at the annual report, we see that as of September 19th, there are now only 418.6 million outstanding shares. So, they're still clearly buying back shares here. And if you believe that the company is currently undervalued, then this is a very, very good move by management. Now let's take a look at the cash flow statement. How much is actually left over for the shareholders in the end? We can see they have an operating cash flow of $6.9 billion here. We have to subtract the stock-based compensation, which ultimately goes to management and employees. That means we deduct this $1.5 billion. Then we end up with about $5.4 billion. And if we also subtract the investments, here, roughly $145 million. Let's round it. We get to about $5.2 billion in free cash flow. All of this is for the first 9 months. Then, if we extrapolate that to the whole year, we end up with about $7 billion in free cash flow, with a current market capitalization of $140 billion. And that gives us a price-to-free cash flow ratio of almost exactly 20. Which also looks attractive from this perspective for a growing company with such a strong market position. And what are they doing with the profits? Right now, they're buying back a lot of shares. Last year, in the first 9 months, they spent $7 billion on buybacks. Now it's $8.8 billion, which is actually more than the free cash flow. That means they've actually made their financial situation a bit worse. But in my view, it's still good, as I showed you earlier when we looked at the balance sheet. But right now, as I said, they're buying back even more shares than the operating business would actually allow. That means at some point, they'll have to scale back the share buybacks a bit. But even then, if they scale them back, they're still at a relatively high level if they use the entire free cash flow for it. If we now take these $8.8 billion and subtract the stock-based compensation up here, we end up with about $7.4 billion that have been used for share buybacks for the shareholders. And that amounts to a good 5% of all shares that have been bought back just in the first 9 months. So overall, we have an industry leader here with fantastic net margins, a business that is still expected to grow, and that also generates high free cash flows. All of this comes at a price-to-earnings ratio of 20, which isn't exactly a bargain. A few years ago, I bought stocks like Meta or Apple at a P/E ratio of 10, 12, or 13. So a P/E ratio of 20 isn't exactly cheap here. But it's also not overly expensive for such a good company, in my opinion. Of course, there are currently risks with AI competition, but it's always the case that companies are only valued cheaply when there are some current problems, which they can also overcome. So here too, Adobe can obviously invest a lot in research and development for new software and further develop their products, thanks to their high free cash flows. At the same time, of course, they already have a customer base, and not everyone is going to disappear overnight, since many people have gotten used to their products. And that's why I think Adobe is definitely a potential buying opportunity right now. And if you're interested in another interesting company that's currently valued at a P/E of 12 and an 8% dividend yield, then feel free to check out my video on UPS. I took a closer look at that company. Enjoy the video and see you next time on German Value Investor.